Materiality. What does materiality means? Is it the same as a material you get from the hardware store for construction? No, it should be something related to studies. So is it the direct materials which we used it in cost accounting? No. Then what is materiality? Let's understand what is materiality as per SA 320, materiality in planning and performance of an audit. Okay, standards on audit, SA 320. Hi friends, I am CA Solepan Kabali, a chartered accountant by profession, a teacher by passion, and a coach by compassion. I have 15 years of audit experience spanning across different MNCs, banks, including Big Four. And I've traveled across 15 countries, across 5 continents for the purpose of doing audit, and audit. And my passion is audit, so I'm here to teach about auditing standard, SA 320. Let's understand what is materiality today. To understand materiality, let's take a real life example in simple terms. So let's say that the scene is there in a bus stop and we see that there are thieves there and somebody is actually losing money. Who is that? The first person is actually a clerk who is earning 8,000 salary. He's actually lost 1,000 rupees from his wallet. Okay, got the scene there. Let's look at the next person. The other person who is also losing money is a businessman who is earning in lakhs. And he has also lost the same 1,000 rupees. So now, who would be more worried about losing that 1,000 rupees? Is it the businessman or the clerk? Yes, you're right. It is the clerk who would be more worried about losing the 1,000 rupees because he's just earning 8,000. It's like, say, what, 12.5% of his monthly salary. He would have a lot of commitments for that. On the other side, if you look at the businessman, he's earning in lakhs. So for this 1,000, yes, of course, he would be worried, but it is not going to matter much for him. So it's not material for him because he's going to move forward. If he's going to take a complaint, go find, chase, investigate, he will be spending a lot of time and efforts on that. In the meantime, he could have earned in his business much more. So he considered that as immaterial and then he moves forward in his life. But at the same time, for the clerk, it is material. Now, do you understand the difference? For one person, it is material, and for the other person, it is not material. So materiality is not a concept which you can put it by a number or a percentage or some kind of a quantitative thing saying that this is what is material. It's actually based on judgment. Whose judgment? In audit, it's based on our judgment, which is auditor's judgment, right? So professional judgment is what is involved in identifying what is material to this client and what is not material to this client. A number can be material to a client, might not be material to a different client. So understand that. That is what is the complexity about materiality. A lot of professional judgment involved in that. How do we find that for each and every client is what we are going to look at through this SA 320. So as an auditor, why do you need to be bothered or worried about materiality? How is it important? Who is asking you to think about materiality? Yeah, SA 320 is talking about it. But then why should you need to know about materiality? Where it is coming from, right? You have these questions. Let's try to reveal the answer for that. Let's get into the standard itself. Let me share the screen and get into the standard and see what is asking us to get into materiality. Okay, now this is what is a standard SA 320, materiality in planning and performing an audit, beginning on or after April 1, 2010. So if we go to the appendix there, you can see SA 200, basic principles governing an audit. This is the primary essay, basic principles governing an audit, and on what aspects we are going to audit. So that is talking about objective and scope of an audit of financial statements. Okay, so here, if you look at it, in conducting an audit of financial statements, the overall objectives of the auditor are to obtain reasonable assurance about whether the financial statements as a whole are free from material misstatement, whether due to fraud or error. Whether due to fraud or error, right? Okay, I'm here, yeah. Whether due to fraud or error, thereby enabling the auditor to express an opinion on whether the financial statements are prepared in all material respects in accordance with applicable financial reporting framework. So the term material is appearing twice in the same statement. So whether the financial statements as a whole are free from material misstatement or not, right? Free from material misstatement or not. So that is what we need to understand. It is not saying it is free from misstatements at all. It is not talking about free from misstatement. It is talking about free from material misstatement. So what does that mean? Only material misstatements, auditors are supposed to report it. So if it is immaterial, then it's okay. So then what is material, what is immaterial is what we need to understand through SA 320. So this is coming from here. So if it is saying, and also if you look at the assurance, is reasonable assurance. It's not absolute assurance. So that means it's not 100% assured that if an auditor is giving an audit report, there is not even a single error in the financials of the company, of the client. So what does that mean? The auditor is giving the financials, or the client is providing the financial, auditor is reviewing, auditing, and finally he is giving his audit report. And that audit report will hold only reasonable assurance. That means it's not absolute assurance, and also it is not having 100% assurance. That is what it means. So it is free from material misstatement is what the user should understand. So there can be small errors here and there. That is okay. That is what the standard is saying. Otherwise, what the auditor needs to do, if the auditor is supposed to give 100% assurance, the auditor needs to sit and review each and every single journal entry, every transaction of the company for the entire year. For larger companies, there might be millions of transactions. So think about it, how we can do. Is it possible or impossible? Impossible? No, it is possible. It is possible, but what is the resources required? Say hundreds of staffs are required, and all those staff, hundreds of staff has to be deployed, and they need to work for 6 months or 1 year to find out every single transaction is right or wrong. So it is possible, but it is really, really difficult, and the timelines are going to take too long, and the cost involved is going to be much heavy, and the client will not be able to bear that. And is it really required? Say if some client is presenting a balance sheet with 50 crore, the total balance sheet, and there is say 1,000 rupees or 10,000 rupees, there is an error or misstatement, and the auditor did not catch it. So whether the users of financial statements, say the shareholders, are they going to be worried if it is going to be 50 crore and 1,000 or 50 crore? It doesn't matter much to them. It's a small minuscule difference. If you compare the percentage of the whole scene, it is going to be 50 crores and 1,000, or maybe even 10,000, or even lakh is going to be small for them, because the balance sheet size is 50 crores, right? And also you need to go into the quality of the issue in terms of what is the error to find out whether it has to be reported or not. Okay. I hope you got a hang of it in terms of what is materiality and why we are doing all these things, because it's coming from SA 200. We cannot do 100% audit. So what the auditor does, he does a sample review. He doesn't do the review of 100% of all the transactions. He does a sample review. So in the samples, if certain items are not picked up, the error items are not picked up, then he might not be able to understand that there is a problem or there is a misstatement. So obviously certain errors can go undetected, right? So that is why we are giving reasonable assurance. At the same time, the auditor needs to give assurance. It's reasonable. So he has to select the sample in such a manner that it is covering most of the population. It is fairly covering the population, and he is doing his thorough job in whatever samples he is doing. And even if one issue is finding in one of the samples, you need to investigate, find out, and see whether it is material or not. He needs to extrapolate and see whether it might be there in other cases in the samples which is not taken. So all those things he needs to do. So that is why we are doing sampling basis, and that's the reason we are giving only reasonable assurance, and it is free from material misstatement. So we need to understand what is materiality now. Let me give you one more example, my own case scenario, right? So when I was a young auditor doing an audit, and I was like posted in Japan to do an audit, I was like so excited. Yeah, Japan, new country. I will explore the country over the weekend, and in the weekdays, I'll do my best and find out all the misstatements, errors, and fraud. So when I was doing, say, inventory, I found out that there are a lot of issues in inventory, and I found that they did not do the computations properly for the closing stock, and also the obsolescence reserve computation was skewed, and it was having a lot of errors, and there were multiple things going on in inventory, and a lot of errors were there. And I looked at what is the total number. It came up to $500,000, so which is $500,000. So I found that, okay, I got a big shark. Now I'm going to discuss all these things with the management, and this is going to be definitely an issue, right? So this is what I was thinking, and I was skeptical that it might be even a fraud. So one fine day I had a discussion with internally, I had a discussion with my audit director who was based out of UK, and she was asking me all the questions I was explaining her. And she was saying, okay, have you looked at the other areas assigned to you, which is say cash and fixed assets? I said, no, I'm spending so much time on this because a big shark is going to be caught in this area. She said, why so big? Why do you think it's so big? I said, $500,000, right? It's $500,000. So she said, don't be excited too much. We are a company of say hundreds of billions, right? So it's not going to matter too much if it's going to be $500,000. It's not material. This is what she told me. She said that focus your work, find out what is that issue. At the same time, look at other areas as well, because we need to balance time in doing all three areas. So ensure that you're getting things done. And yes, if it is 500,000 is an issue, let's report, let's understand what is that, and then let's get that sorted out. But that's not going to be material to be reported. That is what she said. So now you understand, even $500,000 is not material for large corporations, right? So how did she arrive at that? Because that is her professional judgment, understanding about the company, about her knowledge, and what is the size of the error, what is the quality of the error, what is the previous issues or errors in that particular Japan. So all these things put together, she formed a professional judgment thinking that it's not going to be a material error to be reported. Okay, let's get back to the standard and understand what is the standard is all about. Okay, SA 320. So this standard, look at it, it deals with the auditor's responsibility to apply the concept of materiality in planning and performing an audit, financial statements, explains how, SA 450 explains how the materiality is applied in evaluating the effect of identified misstatements on the audit and of uncorrected misstatements, if any, on the financial statements. So what does that mean? This is going to talk only about at the planning stage and at the performance stage of the audit, and not about the reporting stage of the audit. So for that, we have a separate standard, how to find out what to be reported, SA 450, and then the 700 series, we will be looking at how to be reported. So here, at the planning stage, what is materiality, and at the performance stage, what is the materiality, and how we need to arrive at that. So basically, three parts: planning stage materiality and performance stage materiality, and so planning and performance stage materiality, and what are the revisions? Can the auditor revise the materiality during the course of the audit? Yes. So what is that? And the last section is about the documentation. What are all the documentation he has to maintain for materiality? So these are the three sections we are going to handle in this essay. So now let's get into it. So let's look at the point number 2 here. Financial reporting framework often discusses the concept of materiality in the context of the preparation and presentation of financial statements. Although financial reporting framework may discuss materiality in different terms, they generally explain that what is materiality. So misstatements including omissions are considered to be material if they individually or in aggregate could reasonably expected to influence the economic decisions of the users taken on the basis of financial statements. So who is the user first here? The users are going to be the shareholders, the stakeholders, or maybe the bankers. So let's take the shareholders as the users. So the shareholders can be even the individual shareholders, corporate, or maybe institutional shareholders, or fund houses, a lot of different shareholders. And what is the economic decision they are going to take on it? The economic decision is whether to buy the share, if they have already bought it, whether to retain and hold the share, if the share is being already held, whether they wanted to sell the share. So these are the decisions they are going to take. So whether a 50 crore balance sheet is having a 10,000 difference or a material 10,000 as a misstatement, if it is reported in the audit report, is it going to matter for them? Or whether if 5 crore is reported, is it going to matter for them for a 50 crore? Yeah, definitely 5 crore is a big matter for them. It's material. So that is why we need to understand who are the users first. And for them, what is material, we need to understand. As an auditor, it is a tricky thing because we might not know every user for that particular financial statement, but still we can discuss with the management and those charged with the governance and understand who are the users. And based on that, there will be a variety of users. Based on that, we need to form an opinion and form the materiality limits. Okay. So judgments about materiality are made in light of surrounding circumstances and are affected by size or nature of misstatement or a combination of both. So judgments about materiality, surrounding circumstances, we need to look at it. And two things they are talking about. One is size and other is nature of misstatement. So what is the size of misstatement? Whether 1 crore, 2 crore, 5 crore. So that is quantitative. And what is nature of misstatement? That is qualitative. Whether it is fraud, whether it is one time, whether it is recurring, which area of the statement is having a misstatement, financials, right? So all these things we need to look at from qualitative and quantitative aspect. So judgments about matters that are material to users of the financial statements are based on a consideration of common financial information needs of the users as a group. So the auditor clubs everyone as every user as a common user, and he mentally creates a group for them and then says that this is what they will be interested in and this is what they will not be interested in, and this I need to report. So he forms that. So the possible effect of misstatements on specific individual users whose needs may vary widely is not considered. But if there is another user who is typically different from the general users for that particular financial statement, the auditor may not consider them, and that is also not required according to the standard. So general users is what we are looking at. So that is not considered. Okay. Look at point number 4. The auditor's determination of materiality is a matter of professional judgment. That's what I told you in my earlier example. My audit director who used her judgment and said even $500,000 is not material and is affected by the auditor's perception about the financial information, the needs of the users of the financial statement. In this context, it is reasonable for the auditor to assume that. So we are actually in the standard itself is saying we are assuming that the user should have certain amount of knowledge. So what is that? Reasonable knowledge of business and economic activities and accounting and willingness to study the information in the financial statements. So these are all the standard is saying that the user should have. So we are not preparing this financial statement for a person who doesn't even know accounting. That is not the job. They need to know about accounting. They need to know about what is the economic activities and what is materiality. See, look at the next point that talks about materiality. Understand that the financial statements are prepared, presented, and audited to the levels of materiality, right? They should not expect that if the auditor is giving the report, then 100% it is accurate. They should know that there would be a materiality, there might be small errors which the auditor might not be reporting. That is what it means. Recognize the uncertainties inherent in the measurement of amounts based on the use of estimates, judgments, and the consideration of future events. Okay. Make reasonable economic decision on the basis of information in the financial statements. Reasonable economic decision. So the users are going to make reasonable decision based on the financial statements. And what is the third point? It recognizes the uncertainties in measurement of amounts, which is based on estimates and judgment. They should understand that materiality would be based on certain judgments and estimates, and it may be accurate, it may not be accurate. So there are a lot of uncertainties involved in that. So it is applied during both planning stage and performing stage. Okay, and in evaluating stage as well. That will be covered by a different standard, SA 450. So in planning the audit, the auditor makes judgment about the size of misstatement that will be considered material. These judgments provide a basis for size of the misstatements, right? So what is the judgment the auditor is making? So based on these judgments, that will provide the basis for few other items. What are those items? Determining the nature, timing, and extent of risk assessment procedures. What is the risk assessment procedures I need to perform, right? And when should I perform the audit? What is the timing? All those things will depend upon these judgments which the auditor is making about the size of misstatement, which will be considered as material. So if the auditor is considering that even 5,000 is material for that company, then he has to do a lot of work, right? It is inversely proportional to risk of material misstatement, ROMM, right? So basically what we are saying is that if the risk is very high, then the materiality should be very low, because you understand that the client is having a recurring issue or there might be a lot of risk in the client. Then you need to put your materiality level low so that you do a lot of audit procedures to find out what are all the issues and misstatements in the audit, in the financials. If the risk is very less, it's a normal client, and if they are like reasonably good in maintaining ethical or a lot of other parameters, whether they are maintaining the books properly organized and whether the systems are working fine, whether the management is having that right mindset, ethics, and the company is having overall ethical culture. If you find that everything is reasonable, then it's a good client. Then you might say that the risk of material misstatement, it might be very low. If that is low, then what will be happening in terms of materiality? You will set a materiality at a higher level. Why? Because you are fine. There might not be mistakes, so you don't need to add a lot of procedures to find out what are all the misstatements. That doesn't mean that you don't do any procedure. You need to do, but the quantity of the procedures you are doing will vary depending upon how much is the materiality you are setting, and that is derived based on the risk of material misstatement. So the judgments provide the basis for identifying and assessing the risk of material misstatement. That is what we were discussing, Ramam. Determining the nature, timing, and extent of further audit procedures. So what are the further audit procedures we need to do? So that also based on the judgments which the auditor is making in terms of materiality, that will impact. So the materiality determined when planning the audit does not necessarily establish an amount below which uncorrected misstatements individually or in aggregate will always be evaluated as immaterial. Say the auditor has arrived at the number as 50,000. So if something is at 30,000, there is a misstatement, whether the auditor should report it or not. It is again a judgment. That doesn't mean that if something is below 50,000, you will not report. If that 30,000 is related to some critical element, or if it is something related to something statutory element, then he has to report when he will report. So this is only a guidelines or a basis through which the auditor is going to plan and perform the audit. That is not a hard and fast rule which is set on stone that if anything below that number is not going to look at it. Everything is based on judgment. This is a thumb rule or some kind of a number based on which he is proceeding his audit. Okay, so the effective date of the standard is April 1, 2010. The objective is to apply the concept of materiality appropriately. Performance materiality. So planning materiality, performance materiality, right? Two things are there. So what is performance materiality? Means that the amount or amount set by the auditor at less than materiality for the financial statement as a whole to reduce to an appropriately low level the probability that the aggregate of uncorrected and undetected misstatements exceed the materiality for the financial statements as a whole. So what they are saying is that we set up overall materiality first so that whatever number is actually beyond that number, we are going to report it, or we are going to dive deep into it and find out. At the same time, for that is at the planning level. And while performing the audit, there should be a different number which should be set, which is at much, the planning materiality is at a higher level and performance materiality is at a lower level. Why? Because if something is exceeding the performance materiality threshold, you need to investigate, look at that and arrive at it. Because there might be multiple places or multiple classes of transaction or line items or account balances might have this issue. So when in aggregate, when you look at all those issues, let's take an example. Say an auditor is assigned for inventory, another auditor is assigned for fixed assets, another auditor is assigned for cash, another one is assigned for liabilities. So if I am the audit manager, I am saying that say 50,000 is the materiality, overall materiality for the audit. And I'm saying that to all four auditors. And they are going into the audit and performing it. So whatever number, whatever issue they are coming, they'll note it down, and then they see that it is not crossing 50,000. So nothing much to worry about it. And if all four auditors are coming up with saying that I have 40,000 issue, I have 50,000 issue, I have 30,000 issue in terms of material, in terms of misstatement. So if you aggregate it, if you total it, and you come across with the total number of 100,000, now it's again going to be material, right? So what does that mean? You need to go back and ensure that everywhere, see, now you understand they have all completed the work and came back for audit reporting. And now you are seeing that when you aggregate all of them, you are seeing that it is material. So now what you are asking them to do, again, go back to the client and find out why is it 40,000, why is it 30,000, and beat them down and make them correct the misstatement and make a proper financial statement after correcting all those errors, so that it is overall materiality is coming to below 50,000. So to avoid all these things at the later stage, what we are saying is that while I'm assigning it to the auditors, I'm saying that the overall planning materiality is 50,000. At the same time, individually for performance materiality, I'm saying it is 25,000. So if anything is going beyond 25,000, that auditor will report to me or report to the management and escalate it and find out the issue and beat it down at that stage itself. And it will not come till the final reporting stage. So that is why we need to fix a performance materiality at a lower level compared to the overall materiality. Or it can also be, performance materiality also refers to the amount or amount set by the auditor at less than the materiality level for particular classes of transactions, account balances or disclosures. So what does that mean? Say a certain line item, a particular disclosure, say it is related party transactions. So those kind of accounts are being much stringently watched from a CARO point of view and a lot of other statutory point of view. So for that, and also from taxation point of view. So for that, you are looking at much closer, not at the same 25,000 level. Even if there is anything at 5,000 level, you are looking at it. So you set a performance materiality for that particular class of transaction at 5,000, not 25,000. In our earlier example, overall materiality is 50,000. Performance materiality is 25,000. And this line item of related party is 5,000, right? So hope you understand the difference. Now let's get into determining the materiality and performance materiality when planning the audit. If in the specific circumstances of the entity, there is one or more particular class of transactions, account balances or disclosure for which misstatements of lesser amounts than the materiality for the financial statements as a whole could be reasonably be expected to influence the economic decisions of the users taken on the basis of financial statement. Means what? For a particular line item, if there is more weightage given by the users of the financial statement, right? Say the users are more concerned or worried about the liabilities, or because if the banker is actually looking at it, he is more concerned or worried about the assets on which they have pledged, say maybe inventory. So for those items, they are giving a closer look at that. So if the management is saying that, please ensure that this is given closer look and there is no errors or mistake, or the auditor understands these kind of situation based on his risk assessment procedures, and he is setting a different materiality limit for that particular class of transactions or account balances, which will be lesser than the materiality for the financial statement as a whole. That is what we already discussed in terms of the earlier example of related party. So the auditor shall determine the performance materiality for the purpose of assessing the ROMM, risk of material misstatement, and determining the nature, timing, and extent of further audit procedures. Okay, revisions as the audit progresses. What will happen? The auditor is setting the overall materiality based on last year's financial statement. Okay. First of all, how the auditor is setting up these materiality numbers? What are all the bases on which the auditor can set the materiality number? Let's look at the appendix. Okay, where is that? Okay. So the auditor can fix it based on variety of items. Like say he can fix the materiality based on the total assets, or it can be based on the total liabilities, or it can be based on PBT or PBIT, profit before interest and tax, or it can be profit after tax, right? So there can be a lot of benchmarks the auditor can arrive at. So let's look at how the benchmarks are being arrived at. Okay, where is that particular area? Okay. So determining the materiality involves the exercise of professional judgment. A percentage is often applied to chosen benchmark as a starting point in determining the materiality for the financial statement as a whole. So you put a certain percentage on certain number, that is a benchmark. The elements of financial statement, for example, where assets, liabilities, equity, revenue, expenses, on all these items, they can put certain percentage as the benchmark and find out what is the materiality. Whether there are items on which the attention of the users of particular entities' financial statement tend to be focused. So if the users are focusing more on assets, then you put a benchmark on asset. Or if it is basically a trading company and a profit-oriented company which is less of assets, then put the materiality on the profits. So if it is like a more of a manufacturing company and asset-driven company, then put it based on the assets. How much? Say maybe 2% on the asset or 1% on the asset. Okay, let's look at some examples given here. Examples A3. Examples of benchmarks that may be appropriate depending on the circumstances of the entity, including categories of reported income such as PBT, total revenue, gross profit, total expenses. So how is the percentage set? The percentage is again set based on auditor's professional judgment, whether it is 1% or 2% or 5%, whatever the auditor thinks that it is correct. So based on that, he is fixing. So for example, here, the auditor may consider 5% of profit before tax from continuing operations to be appropriate for profit-oriented entity in a manufacturing industry, while the auditor may consider 1% of total revenue or expenses be appropriate for a non-profit entity. So 1%, 5% on different categories he can select, or he can look at and review multiple things and finally arrive at a number based on his judgment. So it's completely professional judgment, and you have a lot of different numbers, and the auditor needs to arrive at that number. So whether some auditor is fixing 50,000, and if another auditor is going to do the audit of the same entity, whether he might also look at the same 50,000 as the materiality figure, may not be. He might look at different computation and arrive at 60,000 or 40,000. It depends upon professional judgment, but it should be reasonably good, and the auditor should document as to how he has arrived at it and what is the basis, and that should be understandable by another person who is having the professional competence to review that and arrive at that reasonability of that particular materiality figure, how the auditor has arrived at. Okay, now we have arrived at the materiality figure, say 50,000 as the overall planning materiality, and you have arrived at the performance materiality as 20,000 or 25,000. Now, is it going to be, so how did you arrive at that? The auditor arrived at that based on last year's audited financials. He looked at the numbers because he's going to start the audit, say in the mid of the year, interim audit. So he doesn't have the end of year financial statement. So last year financial statement, he is looking at it, and based on that, he is arriving at certain numbers. And now, towards the close of the audit, the auditor is feeling that he had fixed the materiality based on last year's profit, last year's asset figures, but current year there are so much of assets addition, and the company has expanded a lot towards the last quarter of the year, and the same 50,000 doesn't hold good. Can the auditor revise it? Yes or no? Yes, but the revision should be to reduce the materiality and not to increase the materiality. Okay, so that is what is being recommended in the standard. So if the auditor is feeling that there is some error or some calculation mistake or whatever it is while he had fixed the materiality based on some numbers given by the client, and it is going some kind of a considerable changes, then he can still review it and revise the materiality. But while reviewing and revising the materiality, it should go down and not up, comparing to the earlier materiality what he had fixed. So, and the auditor also needs to document all those documentation and details has to be mentioned in his work papers, and he has to retain them as to what are the changes happen and why he is revising and what is the final outcome of it. What is the new materiality? So the auditor shall revise materiality, number 12. The auditor shall revise materiality for the financial statements as a whole, and if the applicable materiality level or for individual balances as well, in the event of becoming aware of information during the audit that would have caused the auditor to have determined a different amount or amounts initially, right? So during the course of the audit, he is looking at some differences, so he wanted to set a different number. If he knows these details, he would have set a different number at the start itself. Then he can go ahead and revise the number. So if the auditor concludes that a lower materiality for financial statements as a whole than the initially determined is appropriate, the auditor shall determine whether it is necessary to revise performance materiality. So overall materiality from 50,000, we are reducing it to 40,000. Now we are looking at, say, can we retain the same performance materiality at 25,000, or should we revise that also down? It is required to reassess that, and if it is based on the auditor's judgment, he feels that he has to reduce it down, he can go down to 20,000 or 50,000, 15,000, whatever he feels that appropriate. But it should be less than the overall materiality. Now, the last portion of the standard, documentation. So don't worry about it. We'll also get into one more example and find out in a much clearer terms as to what is overall materiality and what is performance materiality. Okay. So the audit documentation, what it has to have, it has to include the following amounts and the factors considered in their determination. This is the most important term. Factors considered in their determination. So what are all the factors the auditor had considered in determining the materiality? So the materiality for the financial statement as a whole, this is the planning materiality. And then if applicable, the materiality level or levels for particular classes of transaction. So for individual classes of transaction, you are having different materiality set. So all those things and account balance and disclosure. And then performance materiality, what he had arrived at, which is lower than the overall materiality or planning materiality. And for A to C, if there is any revision happening to all three of them or any of the three above items, then as the audit progress, then he has to retain the same level of evidences what he is maintaining for A to C in terms of revision. At the time of revision, why he is revising, what are the documents which changed, and what is the new materiality, and whether he has assessed the other materialities as well, performance and particular classes of transactions. With that, let's get into one quick example and understand whether it is clear. Okay. Okay, let's take this example. This is the financials of Goodwill Company as of 31st March 2021. Mr. Jason's capital. So it's a sole proprietor. So Jason is the proprietor. His capital is 5 lakh and bank loan is 15 lakh. Bills payable is 4 lakh. Plant and machinery 20 lakhs. Bills receivable 3 lakh. Inventory 1 lakh. Total is 24 lakhs. Now, how does the auditor arrive at the planning materiality? So in this case, what we have taken is 2% of total assets. The total assets, 24 lakhs into 2%, it is 48,000. So we are arriving at the planning materiality of 48,000, right? So now, is it only the number? No, it can also be something else. What? It can also be, say, 3% of bank loan. If the company is more skewed on bank loan and nobody else is going to look at it, can be 3% of bank loan, it's 45,000, or maybe 2% of bank loan. Whatever the auditor is arriving at is appropriate according to his professional judgment. Or it can be a percentage on inventory, or it can be on profit as well. So in this case, let's take 48,000 is the planning materiality based on 2% of the total asset. Now he is splitting that. See, as I told you earlier, if every line item here is having the same 48,000 as error or misstatement, which the auditors have found during the audit, but they have not gone to correct them or reevaluate the financial statement and correct the financial statement. So uncorrected mistakes or error are totaling to 48,000 in every line item, then it will become a difficulty. Then finally the auditor will have to report it as material. So now we are looking at, in terms of performance materiality, individually by line item wise, how much we can allocate, like say particular classes of transactions. So for plant and machinery, say let's take 1%, which is out of 20 lakhs, it is 20,000. And say bills receivable, let's say 2%, which is 6,000. And inventory, let's say 1%, say 1,000. And then bills payable, again 1%, 4,000. Bank loan, 15,000, which is 1%. And Jason's capital, this is an area auditor is feeling that there might be some tweaks happen there, or it's actually risky because it's a sole proprietor, a lot of changes might be there. So he wanted to make sure that this particular balance is right. So he is not willing to give any kind of error in this particular number, and the users are also more concerned about it. So he is putting 0. Can we put 0? Yes, we can put 0. So if you put 0, now if you look at it, each and every auditor or the audit staff who is assigned in this, coming up with an error which is uncorrected, in terms of the misstatement is uncorrected, it can be due to error or fraud, it is uncorrected. Individually, this is 15,000. Okay, let's say how much he's coming up with. Say 12,000 is coming up with error. In this case, he's coming up with error 3,000. It is not going beyond this particular line item materiality, so he's okay with it. And say in this, how much? Let's reduce the size a little bit. Okay. So in this side, see, these are the performance materiality or individual class of transactions, right? The same here. But actual misstatements is how much is what we are looking at here. Misstatements. So let's say in terms of plant and machinery, there are some errors which the auditor had found and the management could not correct that because of XYZ reason, right? So there are errors totaling up to 15,000. And in this case, bills receivable, there are errors up to 8,000. So what the auditor will do, he's saying that it is beyond my performance materiality. So come on, correct it. What is the issue? You need to correct it. There is no other option. They escalated to senior management. They escalated to senior auditors. And then finally, they investigate that and then ensure that all the errors are corrected and the misstatements are reflecting the correct numbers. So they were able to correct say 5,000 worth of error. And finally, 3,000 is left over as uncorrected because of various reasons. Now finally the inventory, again here say 800 rupees there is an error. Okay. Now let's see what is the total of uncorrected errors. We are adding these three as well as the other two on the other side. And here the auditor is not allowing anything, so it is 0 only here. So totally 33,800 is the, towards the end of the audit, they are seeing, the auditors are seeing that there is error which is uncorrected in the financial statement is 33,800. If you ask me, is this the only error in the financial statement? This is the error which the auditors were able to identify through their audit procedures and sampling and other techniques. What if there are some other errors which are there in the transactions which the auditors have not reviewed? It is possible. It is there. Undetected errors are also possible. This is detected errors, which is uncorrected in financial statements, right? Detected errors, uncorrected in financial statements. So if you look at, there is a difference. Now the planning materiality is 48,000 and the uncorrected errors is 33,800. So there is 14,200. There is a cushion for the auditor. Still there is a cushion of 14,200. So what does that mean? Even if there are some undetected errors up to 14,200, it is possible, it can be there. Still the auditor is not worried. So that is the final objective of doing all these materiality exercise, putting a number and putting a smaller numbers at different levels and ensuring that it is going below that number in terms of any errors. They are correcting it and giving proper attention. And finally, it has to come below the planning materiality. And still, if there is any undetected errors, for that also there is some amount of cushion. So is that clear? I hope now you would have understood about what is planning materiality, what is performance materiality, and how the documentation should be maintained, right? And how the numbers are arrived at. So it is again hard and fast. There is no hard and fast rule. Any number can be plus or minus as to how the auditor is fixing, but he has to provide justifications on what basis he had given that number. As I told you here, it is 1% is what I arrived at. Here it is 2%, or here also it is 1%. So like that, all the basis has to be maintained properly in the documentation. So if any other auditor is supposed to review that, or any other professional is supposed to review that, the auditor can give a proper justification as to how did he arrive at this judgment and what is the logic behind it. And if they are able to get convinced, then the auditor is safe. Documentation is the most important part for an auditor. It has to be properly maintained. Otherwise, even after years, if somebody is investigating about the auditor's work, checking whether the auditor went hand in glove with the management or not, they'll be looking at all these evidences and see whether the auditor had done his job right or wrong. So for that, these are the papers which is going to talk about how the auditor had done his job correctly. If he is not maintaining these papers, then they might conclude that the auditor is not having evidences. So it looks like the auditor took the planning materiality at 50,000 without any justification, but we feel that the planning materiality should be 10,000. Possible, right? So maintain all the documentation, which is very, very important. And ethics is one of the most vital pillar as an auditor. We need to see that we are growing up as an auditor who is very, very ethical and serving the nation for the betterment in terms of having an overall ethical environment, and integrity is most important. And I hope you like the session, and give your comments in the comment section. And if you still have any questions, feel free to reach out to me or put it in the comments, or look at the description for my contact details. You can reach out to me. I'm happy to help you, and have a nice day. And let us all give toughness to toughness. And that's what is the auditor's job. Thank you. I'm signing off.